Imagine this, if you were only allowed to invest in 5 ETFs, which 5 ETFs would you choose? Pause this video. Let me know in the comments which are the 5 ETFs you would choose. Are you done? Not yet? Pause the video and let me know in the comments 5 ETFs that you would choose. And the reason I'm asking this question is that I want to teach you something very important, which is asset allocation. And this asset allocation can have a huge impact on your portfolio in terms of returns, in terms of the risk, in terms of the volatility. For example, have a look at this data, and what you see is the last 15 years of return comparison between gold, Indian equities, US equities, real estate and debt, 5 different assets. And what you note very quickly, for example, gold, if you look at it, 24, 25 so far, gold is the best performing asset among these 5 assets. But if you go back to 13, 14, 15, these 3 years, gold was the worst performer. Likewise, have a look at Indian equities, right? Indian equities in 2007 were the best performing asset among these 5. But if you go back to, for example, 2016, 2011, huge drawdown in Indian equities. In 2011, Indian equities fell by almost 23%. Point is very simple. Every single year, there may be a different asset class that may outperform. And there may be an asset class that might give you a lot of negative returns. And therefore, if you only have one asset or 2 assets in your portfolio, your returns experience could be very poor. You might see a lot of volatility in your portfolio. You might see your portfolio is down by 20%, 30%. Don't do this. Make sure you have a proper asset allocation in your portfolio. In the last few days, I've been doing a lot of podcasts. Everybody I've met have spoken about how important it is to have the asset allocation, because asset allocation drives 90% of your returns, 80 to 90% of your returns. Therefore, in this video, I'm going to speak about 5 ETFs without which your portfolio is incomplete. Please listen to this commentary with an open mind, as well as do not skip this, because every 1 to 2 minutes, hopefully I'll present you some data that will make a lot of sense and you're going to learn something new. With that, let's get this video cracking. The first ETF I'm going to choose from Indian stock market, and I'm not going to choose Nifty 50 or Nifty 500 because these are broad indexes. I'm going to go with Nifty Midcap 150 index. Now, why Nifty Midcap 150 index ETFs? For this, have a look at my screen and you will see that if you look at the last 20 years of data, you will see clearly Nifty Midcap 150 has beaten broad indexes like Nifty 50, Nifty Next 50, Nifty Small Cap 250 from a returns perspective. How much returns it has given versus these other indexes? It has given around 16.9% CAGR basis returns versus 15.7, 14%, 15.1%. This is what the past is telling me. It doesn't mean that the future is likely to be like this. But if I also give you some granular data, if you look at not just 20 years data, if you look at 15 year, 10 year, 5 year, if you look at these 3 buckets, very clearly Nifty Midcap 150 has comfortably beaten all these remaining indices. Therefore, the growth is coming from midcap segment in the last 15 to 2 years. And my bet is that it might continue to be the case in the future. Again, I could be wrong here, but looking at the past data, I'm going to go with Midcap 150. Another important point that you need to know about Midcap 150 is the volatility. A lot of people say that midcaps are more volatile, 100%. But compared to what? They're more volatile compared to Nifty 50 and Nifty 500. So if you look at the annualized volatility, yes, Nifty Midcap is more volatile as compared to Nifty 50 and Nifty 500. But Nifty Midcap is not volatile as compared to small cap and Nifty Next 50. So if you were to ask me, Rahul, which is that one ETF you will pick, then I'm going to go with Nifty Midcap 150 TR. In my view, in your portfolio, if you don't have a midcap ETF, in my view, your portfolio is incomplete given the past track record of midcap segment in Indian stock market. Now, the natural question, Rahul, which is the best performing ETF? What I've done is I've done a quick comparison for you. There are total 7 midcap ETFs on your screen. None of these are recommendations. It will just tell you in terms of the comparison, where do they stand. So if you look at the liquidity for ETFs, which is the most important factor in my view, that's what I look at. 3-month average volume, if you look at, I've arranged them from highest to lowest. Top 3 are Mirai Asset, Zerodha, ICICI Pru. None of them are recommendations. I'm sharing the data with you. This data may change depending on when you're watching the video. But second is the expense ratio. If I just sort them out from lowest to highest, then Mirai, Kotak, ICICI, these are the top 3. Tracking error almost very similar. I wouldn't look at that. There is not huge difference. Majority of these have not completed 5 year, only 2 have completed 5 year, and those are Nippon and ICICI Pru from a 5-year perspective. I think out of these 7, if you focus on the top 3 from a volume perspective, so let's say Mirai Asset, Zerodha, ICICI, and look at the expense ratio 0.05 Mirai, and ICICI could be the number 2, you can make very well good decision about which ETF you could go ahead with. But depending on the timing when you're investing or entering into midcap, that also is very, very important. And the day when you're buying these ETFs, you also need to check how far these ETFs are from their INAV. Again, I've talked about that concept a lot in my videos. You don't want to pay a premium for an ETF which is trading at a very high pricing value or price point than their INAV. Don't do that, because you will end up paying a lot of premium. Don't do that. Look at when the day you're buying, look at those price points as well, and accordingly you can decide. Again, not a recommendation. Any of these are not recommendations. Have given you comparison. You can do some more comparison at your end. With that, let me now take you to my second ETF that I'm going to pick, and that is going to be from US equity market. Very, very important point that you need to hear out. And I'm going to go with NASDAQ 100 based ETFs. The reason is very, very simple. NASDAQ 100 index gives me the most diversification if I compare from the Indian stock market. For example, here, the data you see on my screen is the correlation data, right? Now, if you look at NASDAQ 100, it is only correlated with Indian stock market Nifty 50 by 23.4%, and Nifty 500 only 23%, versus S&P 500, which is slightly having higher correlation, which is 26%. 25%, meaning S&P 500 is giving me less diversification as compared to NASDAQ 100. Second reason is, if you look at the Indian rupee depreciation over the next 10 to 15 years, very clear pattern that NASDAQ 100 index in US dollars have given less returns. So American people who are investing in dollars are getting less return versus Indians who are investing in the US stock market here. You can see the difference. For example, in 2013, because of rupee depreciation by almost 18%, NASDAQ 100 delivered 38.9% returns to Americans, but Indians got 57% returns. That was the case even in 2024. Slightly, I think around 3% better returns, 5.9% versus 29.6%. So if rupee continues to depreciate, then definitely we are going to get slightly better returns, because we are putting our money in INR and we are getting returns in US dollars. Simple logic, right? Now the natural question is, Rahul, which ETFs can we consider when it comes to NASDAQ 100 index? So I am going to the vested platform, and one of the ETFs that I personally like is Invesco Triple Q Trust. This ETF, if I show you, for example, if I come down here, you note that this is following the NASDAQ 100 index. It has around $402 billion of investments in it. That's its AUM, assets under management. It's huge. It's highly liquid as well. If you look at the volumes traded, 55 million volume is what it has been trading. Expense ratio is not very high, 0.2%, right? And if you look at the sectoral breakdown, it is pretty much following the NASDAQ 100, which is very heavy towards tech. So if you like tech stocks, then this is the one that is giving you that exposure, around 55%, right? If you look at the top 10 holdings here, you can go and look at Nvidia, Apple, Microsoft, Broadcom, Amazon, Tesla, etc. Again, you can see that data as well. Second one that I personally like, you can also explore, is Invesco only, Invesco NASDAQ 100 ETF, which is Triple QM. This one is also very, very liquid, but liquidity is slightly less here. It is around 4.91 million. And total assets are also quite low, $67 billion compared to the first one. But here the advantage is that the expense ratio is slightly lower, 0.15%. Rest all features are more or less same, because it is essentially tracking the NASDAQ 100 index. Sector allocation is same. The top 10 companies are likely to be very same, right? Now, in terms of when to invest in these ETFs, that is your call. You might say that right now US market is all-time high. I do not want to invest. That's your choice. You might say that, Rahul, I want to do SIP in these US ETFs. That's your choice. You might say that, Rahul, I am going to buy the dip whenever there is a fall. That is essentially your choice. Point is very, very simple. My intent is to teach you why the asset allocation is very important, right? And if you have not yet opened your US account with Vested, I've given you the link as well. If you use my link, you are going to get extra benefits. What is the extra benefit? If you open your account with Vested and you make your first deposit, then Vested is going to give you $10 bonus fund added into your account. So that is the advantage you're going to get. I've given you the link in the description and pinned comments. You can use it if you wish to. The third ETF that I'm going to go with is gold ETF. Reason is very, very simple. If you look at this data, what you see is that gold has kept its relevance across multiple civilizations, across multiple economic eras, right? For example, going back to 3000 BC, if you look at ancient Egyptian civilization, they were using gold as a value of store, right? And that's why our great grandparents passed on this wisdom to us that make sure you have gold in your portfolio. Very, very important point, right? Even if you look at the modern era, since for example 1400, you will see that gold is the real money. That's what JP Morgan says. And you see how gold has been recognized as the single most currency that is universally accepted by all countries. Last point about gold, if you go back to 2000, if you only had 5,000 rupees, by 2025, that cash would have become to 1,500 rupees, lost its value. But if you look at the gold, if you had the gold, 5,000 rupees worth gold in 2000, that would have become 1,09,000 rupees. I think this is a very, very important point that we all understand that gold has to be there in our portfolio. Therefore, the natural question is which gold ETFs are good, Rahul, right now? Before that, please go and watch this video. It will clarify a lot of things about what's happening in gold right now, who is investing, who is not investing, whether central banks is the one that is driving the gold prices up or not. Everything I've talked about in this video last 3 weeks, more than 2 lakh people have watched it. You're going to learn a lot, right? But coming back to gold ETFs, let me talk about which are the gold ETFs. I can give you some comparison insights. Again, none of these are recommendations. Have a look at my screen. Around 23 gold ETFs you see on my screen. I have sorted them by the highest 3 months average volume, meaning the most liquid ones are on the top. Tata, Nippon, Gold Bees, SBI, ICICI Pru, Zero, all these are the very good gold ETFs in terms of the liquidity. Expense ratio also I have given you here. So if we go, for example, Tata Gold is at 0.40. Nifty Gold Bees is very costly, 0.80 comparatively. SBI is 0.70. ICICI Pru is cheaper, 0.50. Zerodha is even cheaper, 0.32, right? You look at the trading volume, you look at the expense ratio, tracking error data is not here, unfortunately. Look at which are the 5-year-old gold ETFs. For example, Nippon Gold Bees is 5-year-old, SBI is, ICICI. So these have been out there for the last 5 years. But in my view, I look at the 3-month average volume. That is very, very important from a liquidity point of view because it helps me quickly sell it in the market, quickly buy it from the market. I don't need to pay a lot of premium when I'm trading it on the exchange. So these are my parameters. Again, none of these are recommendations. You can go with what you like, but hopefully you have gold in your portfolio, and gold ETF is one very good option in my view. Why? Simply because if you compare the gold ETF versus physical gold, it's very easy to buy and sell on the market, right? No making charges, no insurance charges. It's guaranteed 99.5% purity. In fact, it is a security that is regulated by SEBI, so you don't get trapped into any other idea. So hopefully that point is very, very clear. I definitely will go with third ETF, that is going to be gold ETF. So far, if you're liking this video, if you're finding this analysis useful, request you to hit the like button. If you have not yet subscribed to my channel, I think it's time for you to subscribe to this channel because almost in every video I'm presenting you data, letting you make the decisions. I'm not pushing you for anything, and hopefully you understand that point. Also, if you want to get exclusive content on my YouTube channel, then you can join my YouTube community. Almost on a daily basis, I talk about various assets, for example, stocks, ETFs, mutual funds, and many other assets, bring you a lot of insights, and that makes you a good investor over a longer period of time. The feedback of this community has been excellent. Go to my channel, find the join button, and be my guest. With that, let's move to ETF number 4 that I'm going to definitely pick up in my portfolio if I was only allowed 5 ETFs. Fourth ETF that I'm going to pick up is silver ETF. Now you may say that, Rahul, everybody's talking about silver now because silver has given a massive rally now. Why were you not talking about silver 6 months back, 1 year back? Actually, if you look at my channel, 6 months back, I created a video about silver. I said that silver bull run is likely to continue. Please go and watch that video. It's not that I'm talking about silver first time. You'll find on my channel videos that I've given very good deep insights about what is driving silver's bull run, right? Please go and watch that video. But coming back to quick 2-minute commentary about silver. Here is what is driving silver's prices up. Silver demand is very high and supply is very low. There is a deficit since 2021 and the deficit is around 21,000 of tons as per Motilal Oswal's data. So definitely when the demand is very high and supply is very less, what is going to happen? Silver is going to give you breakout in terms of price movement. Now coming to what is driving this demand, we all know that this demand is coming from industrial use. For example, in 2024, 80% of demand has come from outside jewelry and silverware, which are the industries, EVs, solar panels, electronics. These are the ones that are driving the huge demand of silver in 2024 and 2025. Now the big question, is this a good time or bad time to buy silver? Again, I've done some analysis for you in this particular video. Very recently I released that video. I'm not going to repeat all of that. Please go and watch that video. You will get my point of view. I could be totally wrong here, right? Now coming to my last point on silver ETFs, how do we go about choosing silver ETFs? So what I've done is I've created a screener here. Very quickly, let me show you. I've got 16 silver ETFs. Again, arrange them from the highest trading volume to lowest trading volume in the last 3 months. And if you look at that, top 3 or 4 are Nippon India Silver ETF, right? Followed by Tata, followed by ICICI Pru, Zerodha, HDFC. These are the top 5 from a volume perspective. If you look at, for example, the expense ratio, then out of these 5, the lowest expense ratio is Zerodha as of now, right? Followed by ICICI Pru, which is at 0.40, right? Tata is 0.44. From a last 1 year return perspective, if I sort it out by highest to lowest, then Tata has given the best. DSP has given the next returns. Mirai Asset is number 3. Again, very minor differences in the returns as such. My perspective always has been that we look at the volume. That is the most important thing, followed by the expense ratio, followed by the tracking error. If you have the data here, I can't find the data about tracking error, so I can't share that data with you, unfortunately. If you look at the last 5 years CAGR, none of these have completed 5 years, so they are fairly new in the market. Therefore, you go and explore yourself, and depending on when you want to take an entry in silver, you make sure that you know which ETF you are going to pick. That is your choice that you want to make. With that, let me now move to the 5th ETF, which is the most interesting ETF in my view. Although this is not going to give you solid returns, but the utility of this 5th ETF is huge. People have highly underrated this particular ETF. Let me talk about that in a quick few minutes. So the 5th ETF is liquid ETF. And why is it very, very important? Everybody who is investing in markets must have this in their portfolio, simply because we will have idle funds lying in our accounts, right? For example, if I've sold a stock, I've got some money back, I'm waiting for new stock opportunity to emerge. What would I do? This money, if I keep it in my bank account, I'm going to get 2-3% of annual returns. If I put that in liquid ETFs, I might get 6%, 7%, 8%. I'll show you the data in a minute. Point is that it helps you manage your idle funds. Point number 2, cushion against market volatility. Whenever the market is falling and you can anticipate that, you think that there is going to be a bear cycle now, what you do is you take out some money from equity, put that into liquid ETF, wait for opportunities to come in. If the market valuations are very, very high, then you don't put all of your money at a very high valuation. You wait for valuations to calm down, cool down, then you take your opportunity. Therefore, it helps you make those decisions. Lastly, smarter cash management. The day you sell a stock, you get your money into your account, into your demat account. What do you do with that money? You put that immediately in liquid ETF, because even if that lies for next 3-4 days, you've managed that cash in a very, very smart way. You'll get some returns out of it. Therefore, in my view, liquid ETFs are extremely important for people who are building good portfolios. People who want to really learn, they need to learn about liquid ETFs. On liquid funds, I've created this video. Please go and watch that so that you understand the concept. I'm not going to go into a lot of details here, but point is very simple. From a returns perspective, last 12 years, 13 years of data is in front of you. What you note is that it could give you different returns at different time periods, 7%, 8%, 6%, 3%, 4%, 6%, depending on a lot of factors. Here, we are not looking at returns. What we are looking at really is a smarter cash management. We are not leaving our money in the accounts where it is just sitting idle, not doing anything. Therefore, it is always better to put that money to some use, and liquid ETFs is one way to look at that. Now, which are the liquid ETFs, Rahul? Then again, what I've done is I've created a screener for you. You can see 12 liquid ETFs here, right? What you note is that 3-month average volume wise, Zerodha, Nippon, Kotak, Grow, DSP, these are the 5. Last 3 months average volume has been very, very high. Here you have to ignore everything else, in my view. When you're going for liquid ETF, please make sure you're going with the most liquid one. Why? The reason is very simple. You want to sell it immediately if there is an opportunity comes. You don't want to get stuck. You don't want to pay huge prices when you're selling or buying it. You want to make sure your impact costs are lower. Therefore, average volume is very, very important. This data may change from time to time. Therefore, whenever you want to invest in liquid ETFs, please go and look at NSE website. Look at what the average volumes are, and you will know what is the difference between INAV versus the volume. Again, I'm talking about a lot of things here in a hurry because this is not a full video on liquid ETFs. If you want me to create a full video on liquid ETF, let me know in the comments. Maybe in the future, I'll create a good video on liquid ETF giving you everything that you need to know. But this is going to be my 5th ETF that I definitely would have in my portfolio, without which I would consider my portfolio incomplete. Why? Because I'm not able to manage my money in proper way then in that case, right? Hopefully you like this video. Request you to hit the like button. Let me know in the comments. It's simple. Thank you. It motivates me a lot to do a lot of research for you, bring some quality content for you at zero cost. If you want to join my YouTube community, then simply go to my channel, click on join button and be my guest. You are going to learn practically a lot. With that, let me know in the comments, out of these 5 ETFs, which ETFs you don't have in your portfolio and whether you plan to add them or not. I would love to read your comments. With that, I'm going to see you in my next video. Until then, keep rocking.